So the second one I wanted us to look at is when we sell the goods, this time on credit. And I've explained that to mean the business did not receive the money from the customer, right? So when that happens, again, my professors, I think you can tell me about the effect. We sell our stock and we didn't receive the money. So the person becomes a debtor, the customer becomes a debtor. So what can you tell me about the effects? What is going to happen in terms of something increasing or the other decreasing? Yes, let me hear from you, professors. Okay, Prof. Portia, go ahead.
Sir, please, I want you to come again.
Okay, so I'm saying that looking at this one, we sold the goods to Kwame on credit, right? So what is the effect? What is going to happen?
Say, okay, since we sold goods to Kwame and our stock, which is our asset, will decrease, we
Okay,
must credit sales
okay,
and we'll debit Kwame by the amount 500.
okay. So the effect, I want the effect. Increase in what, decrease in what? That's what I want.
Okay, so said there'll be a decrease in asset stock by
Uh-huh,
500 CDs,
uh-huh.
and there'll be a increase in cash, assets cash, 500 CDs.
Why is cash coming into the picture? Do you see cash in this transaction?
Okay, say no.
Mm-hmm. Okay, who is going to assist Portia in that regard? Akoli, Oswell, Emmanuel, Eugenia, and Zoe. So I think now we all agree. Okay, I've seen something in the chat. Let me read that. Akoli is asking, are debtors liabilities? Akoli, I should ask you that question. Are debtors liabilities? Okay, Portia wants to redeem herself. Portia, go ahead.
So, sorry, there'll be an increase in liabilities by creditors, 500 CDs. But Kwame's name will be there since his name has been stated in the question.
Portia, I don't know. I really need to investigate whether you have issues with some creditors because you always seem to mix creditors and debtors up.
Okay, sorry, that says.
Okay, so let me answer the question from our colleague. Our colleague, debtors are assets. When we say a debtor is a customer, okay, that the business supplied goods to, but the customer didn't pay. So, for example, if we are a business and we sell pens, if we sell pens to the students and the student don't pay, remember the students are our customers, and customers are the group of people we sell to, the business sells to. So if they don't pay, then they become debtors, and it is an asset, a current asset to be specific. So don't confuse sales and purchases. Purchases, on the other hand, is where the business is buying the goods from suppliers. So our pen business, if we go and purchase or buy the pens from Melcom, then Melcom is our supplier. So if we don't pay Melcom, then Melcom becomes a creditor. So creditors are associated with suppliers and purchases, while debtors are associated with customers and sales. So get those things straight, okay? So debtors are assets, and then creditors are the liabilities. Are we comfortable?
Yes, sir.
Okay, thank you. So in this case, we sold the goods to Kwame on credit, meaning Kwame did not pay. So Kwame becomes a debtor, and a debtor is an asset. So the effects are going to be that there will be decrease in asset stock. That one, I think we all appreciate that one. The corresponding effect will be increase in another asset, but this time the asset is a data. And like Portia said, the name of the data has been given. So Kwame is what we are going to use in terms of preparing the account, right? Now, I don't know. I want to make this thing as practical as possible. Professors, imagine you sell bags, okay? And then you sell a bag to your friend, let's say Amma, and Amma didn't pay. If you are doing your analysis, you realize that, okay, the stock of bag you have has decreased because you have sold some to Amma. So there will be decrease in asset stock, right, which is your bags. But you also acknowledge that Amma is owing you. So Amma is a debtor. Okay. And of course, Amma didn't owe you, so your debtors were 0. Now she owes you. So it has increased. So there will be increase in asset data. I don't know if you get it. If you are still confused, please, because I want us to get this once and for all, because the basis of accounting. Okay. Recording using this double entry is very, very crucial. Okay. So in terms of opening the account, I've indicated to you, decrease in asset means we have to credit. But then you see stock here. Don't open stock account. Look at the transaction. What is happening? We sold goods. So that will be what? Sales. So we open sales account. And then the corresponding account will be the debtors account, but the name of the debtor has been given. So use the name of the debtor, which is Kwame. If the name was not given, then you could have written debtors account. But if the name is given, use the name of the debtor. And I believe that is well understood. Okay, so per the principle, decrease in asset stock, and we've realized that should go to sales account. So when asset decrease, we credit. So we put it on the right side. The date is 7th January 2022. The details will be the other account, which will be Kwame. Then you put the amount there, 500. If you come to Kwame's account, that was an increase in assets. So you debit Kwame, right? So we debit Kwame on the date 7th January 2022. The details will be sales, okay, and the amount will be 500. Professors, is that okay for us?
Yes, please.
Okay, so I'm going to put some 2 transactions here, and I'll see how my professors will digest it. So transaction number 1. On 15th March 2025, sold. Okay, Portia, you have a question? Go ahead.
Say please. I read from somewhere that if the stock, which is an asset, decreases, the sales account must be credited.
Yes.
Please, but here, okay, wait, must it be debited in the person who came to buy our goods?
Yeah.
His account book, or it might be debited in our account book for that debtor.
Sure. So the point you made is true, that when stock decreases, what do? You credit the sales account. And this is the sales account. And what have we done? We have credited the sales account, okay, for the stock that decreased. But for the person we sold to on credit who becomes a debtor, we saw that there will be an increase in that asset data. Hence, we debited the person who is the debtor's account. So the point you made there is very true. Akoli, I saw your hand up for a question.
Say,
Yes, go ahead.
I don't guess what she said.
Oh, what she said is what we have discussed, that when asset decreases, when asset decreases, you credit. So the asset stock is decreasing when you make sales. Okay. And so we are supposed to credit. But what account are we supposed to credit? And I've indicated to you, you don't open stock account, you open sales account. Okay, so I have this transaction on the screen. On 15th March 2025, sold goods to Efia $8,000 on credit. Professors, I want your analysis on this transaction. First of all, tell me the effects before we go to the account that we have to debit. I think I want Eugenia to speak on this one first. Prof. Eugenia. Sorry, Prof. Zoe. Prof. Zoe.
Sir, please, good morning.
Morning.
So there will be increase in cash. Sorry.
Don't worry, take your time, okay? Take your time in doing your analysis. Sold goods to Efia on credit.
Sir, please, I'm thinking about it.
Okay. Organize yourself. I'll ask again. Prof. Emmanuel Kujo.
Yes, sir.
Please share your thoughts on this one.
So the effect will be that the liability increase and credit and cash or asset to decrease.
Okay, so I'm hearing decrease in asset, which is correct. But what asset is decreasing?
The goods.
Okay, so that's the stock. So thank you. There will be a decrease in asset stock. So please, as for that one, you should always get it. Anytime you sell goods, there is decrease in asset stock. That one is simple, right? Now let's look at the other effects. So as the stock has decreased, what else is going to happen? I see Portia, I see Akoli and Josephine. Okay, I see Austin too. I don't want to call them. I don't want to call them. Okay, let me call Josephine to share on this one. Prof. Josephine.
Sir, please, there will be increase in assets data.
Okay, so there will be increase in asset data. Great. So please, if you are still not getting it, just relax. Okay. Anytime you sell goods on credit, what it means is that you sold the goods and you didn't get money. So cash will never appear in this context because you sold the goods on credit. You didn't take money. So the two things happening here is your goods you have sold, which is the stock, and the person who is owing you the data. So anytime you sell goods on credit, it is your stock and your data. What happens to your stock is that there is a decrease in that asset stock and increase in asset data. Professors, if for nothing, what they do it chew and pull, that anytime you sell goods on credit, your asset stock decreases and your asset data increases. For now, do chew and pull. And I'm sure as you move on, you would appreciate and understand, right? So now that you know this, the two accounts you have to open will be your sales account, okay? Because we said anytime you sell goods, you open the sales account to represent the stock account. So sales account, and then we'll have the data. And here the name of the data is given, so we use the name of the data EFIA. Okay. Now, who do we debit? Who do we credit? So let's apply the principle. Austin, is that a question? I'll come to you for the question. Okay, so hold on. So you have your sales account, which is for the stock, right? And then you have the debtors account, which is EFIA. So if we look at the stock, the asset is decreasing. And per the principle, when asset is decreasing, we credit. So it means we have to credit our sales account. 15th March 2025, the narration will be EFIA, and you put the amount 8,000. Right. On the other hand, we will debit EFIA, okay, because the asset data EFIA is increasing. So you debit 15th March 2025. The narration will be good, sales, and you put the amount 8,000. Okay, let me get the questions. Austin, let me hear your question first, then I'll go to Portia.
Sir Peter, I wasn't asking a question.
Okay, thank you. Portia, let me hear your question.
And say, please, there's a saying that say debits the receiver, credits the giver. Okay, but in what we are doing, does it mean that we sold the goods to EFIA, so we are the giver? So EFIA, in EFIA's account, should we like credit ourselves or we should debit ourselves?
Okay, I think you asked this some time ago, and I indicated to you that debit the receiver, credit the giver is the application of the double entry principle on transactions that involve persons. Okay, so we'll look at the types of account, and one of them is personal account. That is account for people, persons, individuals, or firms. So, but you can also apply that principle here that if you have a transaction and there's a person involved, ask yourself, is the person receiving or giving? If the person is receiving, you debit. If the person is giving, you credit. So in this context, we sold the goods to EFIA. So EFIA is a person, right? So if you ask yourself, is EFIA receiving or giving in this transaction? Of course, she is receiving. So yes, we have debited EFIA. But I caution my students with application of the double entry principle on personal account, because sometimes if you are not careful, you might make an error. And I'm about to do that. Okay, I'm about to give an example that may commit you if you look at that debit the receiver, credit the giver. So I normally recommend that do the analysis and know the increase in asset, decrease in whatever, and apply this principle. Okay, this principle of if assets increases, debit. Okay, apply that one before you now move to the personal account and all the other types of account, nominal account, etc. Okay, so don't worry, Portia, we'll gradually zoom into that space where you know the bits about debit the receiver, credit the giver. Okay.
Okay, sir. Thank you.
You are welcome. Okay. So let's move on. So I'm going to put another example on this sales, and I'll see how my professors are going to fare. I think this should be the last example. Then we'll look at purchase of goods. Right? So on 20th April 2075, sold goods to Araba. I think it seems I'm using only female. Let me use it. Sold goods to Kofi and received a check of 3,000 Ghana cedis. Okay. So let's look at this transaction. On 20th April 2074, sold goods to Kofi and received a check of 3,000 Ghana cedis. So we sold goods and we received check of 3,000. Professors, I want to hear you on this one. Portia is in the lead, but I want a different person. Prof. Bridget, I think you were struggling with your network. I don't know if you can assist us in this regard. Okay, I have Portia, Josephine, Augustine, Okoli. Again, they would have to wait for me because I want some professors to speak to me. Zoe, can you come back again on this one?
So, decrease in assets stock and increase in debt.
Okay, so we have decrease in asset stock. That was beautiful. But the second one, she started very well. Increase in assets, but she got the specific asset mixed up. So what asset has been mixed up? Augustine Akoli. Zoe has started perfectly, so I need someone to complete it.
Deputy said.
So complete the second part. Increase in asset what?
So, increase in assets bank.
Exactly. Increase in asset bank.
And decrease in asset goods. Also asset stocks.
Exactly.
Stock,
so there we have it, right? So Zoe, there is an increase in asset, but that asset is bank because of the check. The business received check from Kofi. Okay. So Prof. Portia, this is where I caution my student. If you apply the debit the receiver, credit the giver, you may be tempted to think about Kofi, that Kofi was receiving goods. Okay, but in this transaction, when we sold the goods, we received our check. Okay, so we are only interested in the goods we sold, which is our stock, and then the check we have received, which is the bank. Kofi will not be in our books. Now, having said that, let me make this point. If you are doing business and you are selling something, when you sell to the person and the person pays you your money, you see, you are not even interested in the person again. You only get interested in the person when the person didn't pay. Then you try to note the person that, oh, this person, Kwesi, is owing me, right? So always be careful when you are analyzing your sales transaction. Okay. Now, in terms of the accounts, okay, I think Portia wants to comment on that one. Yeah, I'm listening to you.
Sir, please. So, like, the question is, the sold goes to Kofi and received a check.
Yes.
So if we have this thing, writing down the accounts for the sales accounts, like you're opening the sales accounts book,
Yeah.
and we'll credit Kofi, like we write Kofi's name or write the bank there.
Yeah. So
Since
Kofi will not come into our books because Kofi has paid the money. So in our books, we would only recognize our sales account and the bank account, right?
okay,
Kofi will not
thank
come
you.
in the picture. Yeah. Kofi will only come into our books if he didn't pay and became a debtor. Uh-huh. Okay, so let me record the transaction in the account. So like you all know, when you see stock check, we sold stock, so that will be sales account. So we open our sales account. Please, if I see any of you opening stock account, I'll knock you through your momo. Then we have our bank accounts. So these are the two accounts we open. Now, who do we debit? Who do we credit? Let's do the analysis. The sales account is in respect of the stock, which is a decrease in asset. And when asset decreases, we credit, right? So credit the sales account 20th April 2075. Then the narration there will be bank, and then we put the amount there, 3,000 Ghana cedis. Then when we come to the bank account, we appreciate that it was an asset that has increased, and when asset increases, we debit. So 20th April 2074, the narration will be sales. That's the corresponding account to the figure there, 3,000. And that's all. You have recorded your transaction. Make sure to put your currency on top, otherwise you lose marks. So always put your currencies at the amount column on both sides. Okay. I believe we are cool with the sales transaction, right?
Yes, please.
So I think we'll add on the next one, which is purchase of goods. Purchase of goods. As a matter of keeping track of what we are doing, we have finished with investment by the owner. We have now added sale of goods. And we are now moving to purchase of goods. Gradually, we are going. Please don't be left out. If you have any question, bring it up. Okay. So purchase of goods. When the business purchases goods, right? When the business purchases goods, again, the business can settle cash or check, or the business will purchase it on credit. So as you see here, purchase of goods or stock, it can be done with cash or check or on credit. So if you follow the example I gave, if we are selling pens and we go and purchase it from Melcom, then when we go to Melcom, we can pay Melcom with cash or check, or we can tell Melcom we'll come and pay you later. And then at that point, Melcom, our supplier, will become a creditor. And creditors are liabilities, current liabilities, because we now owe them. Okay. Having made this point, let's take some examples and see what happens. So this time, you see, when you purchase the goods, your stock will increase because you are getting more goods, right? So your stock will always increase when you purchase. If you purchase with cash or check, then you know that your cash or bank will decrease because you are making payment for that goods you have purchased. If you didn't pay, then it means you have a liability, which is a creditor, because you now owe the supplier. So let me pick some examples. Then let's see how we'll deal with it. So the first example I'm picking or putting on the screen is, please, one of you should read it for me. My food. Prof. Bridget, read it for me. The food I ate is gone. Prof. Bridget, yeah.
Purchase goods worth 3,400 cedis from Shatter Limited on credit on 14th January 2022.
Okay, thank you very much, Prof. Bridget. When I heard a Shatter, I thought you were going to add Wally. Okay, so purchase goods worth 3,640 from Shatter Limited on credits. So we are purchasing goods from a supplier, and Shatter is our supplier. We didn't pay Shatter. So dear professors, let me do this one. Okay, there will be increase in asset stock. Note, we are purchasing, so our stock will increase, right? Which is the opposite. When we are selling, the stock decreases. Now, because we didn't pay, it will lead to an increase in liability, and that liability is a creditor. And here the name of the creditor has been given Shatter Limited. And I hope my professors agree with me on this one. Yeah, Augustine.
Yes, please.
Say, please, I don't get it.
Which part don't you
Please, I
get?
don't get it.
Which part don't you get?
So so what you just said, like,
Okay,
what you said.
Okay, so if you are a business, Aquali Limited, you buy and sell cars, right? Then
Yes,
you go to Toyota Company Limited and you purchase car from them. What will happen to your cars? Won't it increase?
Yes, sir.
So there will be increase in what? Your asset stock, the goods that you are selling. Now, if you didn't pay Toyota, then what is the meaning of that? It means you owe Toyota, right?
Yes, sir.
So your liabilities is going to increase because you are owing them. Do you understand?
Yes, sir. Thank you, sir.
So there will be increase in liability. The supplier you didn't pay. So the example I gave for you, Akoli, if you purchase a car from Toyota and you don't pay Toyota, this is what is going to happen. You would have an increase in asset car, and you would also increase your liability, which is you owe Toyota. So Toyota will become your creditor. Do you appreciate it now? Or you are still confused, Professor?
Yes, sir. They misunderstand us.
Okay, great.
Thank you, sir.
Okay. So, dear professors, I think we'll continue with this transaction in the next session. Let's all join and finish up with the purchase of goods and wrap up with today's class. Okay. See you in the third session.